The investing war nobody understands until it's too late. You know what's funny? People will argue for hours over dividend stocks versus index funds, while investing absolutely nothing. They'll debate yield percentages, talk about passive income, watch 47 YouTube videos about retirement, and still leave their money sitting in a checking account, losing value every single day. But the people quietly getting rich, most of them picked a strategy years ago, automated it, and disappeared. That's the part nobody glamorizes. Not the stock ticks, not the market predictions, just consistency. And today, I want to show you why this argument matters way more psychologically than financially. Because one of these strategies feels rich immediately, while the other quietly builds enormous wealth in the background. And if you misunderstand the difference, you can accidentally sabotage decades of compounding while convincing yourself you're being smart. Let's be honest. There's something deeply satisfying about dividends. You wake up, check your phone, and Coca-Cola just paid you money for existing. No clocking in, no customer complaints, no boss. Just cash appearing in your account while you were asleep. That feeling changes people. It makes investing feel real, not theoretical. And psychologically, that matters more than most finance bros understand. Because during a market crash, dividend investors still see money arriving. The portfolio might be bleeding red, but the cash flow continues. And emotionally, that feels like safety. This is why so many retirees love dividends. Not because they mathematically outperform everything else, but because dividends reduce panic. And panic destroys more portfolios than bad investments ever will. But here's the part nobody tells you. Dividends are not free money. And this is where YouTube gets dangerously misleading. When a company pays a dividend, the stock price usually drops by roughly the same amount. Meaning, the company didn't magically create extra value. It simply transferred part of the business value back to shareholders as cash. That's it. Which means the feeling of getting paid can sometimes trick investors into believing they're generating wealth, when in reality, they're partially liquidating the company's value in slow motion. And honestly, most people never fully understand that distinction. Now this is where things get dangerous. Because once people fall in love with dividends, they start chasing bigger dividends. 4% becomes boring. Then they want 7%, 9%, 12%, and suddenly they're buying companies that look less like investments and more like financial crime scenes. Because extremely high yields are often warnings, not gifts. A company paying 12% might not be generous. It might be dying. And this is how people quietly destroy retirement portfolios while believing they're being conservative. The yield pulls them in emotionally, right before the dividend gets cut and the stock collapses. Most people never see the trap until the damage is already done. Now, let's talk about the other side. The index fund people. The people who sound almost offensively calm during market crashes. These people don't chase hot stocks. They don't care about headlines. They don't spend 4 hours analyzing earnings reports. They just buy the market, over and over and over again. And honestly, it sounds too simple to work. That's why people resist it, because humans associate complexity with intelligence. If something feels boring, we assume it can't create extraordinary results. But the entire history of investing keeps quietly proving otherwise. An index fund is basically you admitting something emotionally difficult. You probably can't consistently predict the future. That's the philosophy. Instead of trying to find the next winning company, you simply own all the major companies. Apple, Microsoft, Amazon, Google, Nvidia, hundreds more. You stop trying to outsmart the economy and simply become part owner of it. That shift sounds small, but psychologically, it changes everything. Because now, you're no longer betting on one company surviving, you're betting on human progress itself. And historically, that has been an extremely profitable bet. Here's where index funds become terrifyingly powerful. Fees. Tiny little percentages that look harmless, until time turns them into monsters. Most actively managed funds charge around 1%. Sounds tiny, but over 30 years, that 1% can quietly steal hundreds of thousands of dollars from your future wealth. Meanwhile, some index funds charge almost nothing, 0.03%, practically invisible. And this is what rich investors understand. Tiny advantages become enormous over long periods of time. Index investing sounds easy until the market crashes 35%. Because unlike dividend investors, you don't see comforting cash payments arriving. You just see pain, numbers collapsing, fear everywhere. And this is where people discover who they really are emotionally. Because during a major crash, your brain stops sounding rational. It starts sounding primal. What if this time is different? What if the market never recovers? What if I lose everything? And this is why most people fail at investing. Not because they picked the wrong strategy. Because they couldn't survive their own emotions long enough for compounding to work. Now here's where the debate becomes fascinating. Retirement. Dividend investors love the idea of never selling shares. They want their portfolio producing enough income to live on forever. That feels incredible. Your assets stay intact while cash keeps arriving. But mathematically, that often requires a much larger portfolio than people realize. To generate $50,000 annually at roughly a 3.5% yield, you need around $1.4 million invested. That's not impossible. But it's bigger than most people expect. Meanwhile, index investors often use something called the 4% rule. Instead of living only off dividends, they gradually sell tiny portions of the portfolio each year, which means they may need slightly less upfront wealth. But emotionally, selling assets feels terrifying, even when the math says it's fine. Humans hate seeing share counts go down, even if their net worth is still enormous. And this is why investing is never purely mathematical. It's psychological survival. So which strategy actually wins? Honestly, the answer most people hate is this. The best strategy is the one you can survive emotionally for 30 years. Because the greatest investment strategy in human history becomes worthless the moment you panic and quit. And the truth is, most wealthy investors accidentally combine both approaches anyway. They own broad index funds, while also holding dividend-producing assets for emotional stability and income. Because eventually, you realize investing isn't about maximizing every possible percentage point. It's about building a system you can stick with while the world loses its mind around you. Here's the uncomfortable reality. Most people spend more time researching Netflix shows than retirement strategies. They obsess over timing the market, picking the perfect stock, finding the highest yield, while ignoring the one thing that actually creates wealth: time invested. That's it. Not brilliance, not prediction, time. And every year you delay investing because you're trying to find the perfect strategy, compounding quietly leaves without you. Somewhere tonight, a 24-year-old is buying their first index fund. Another person is buying their first dividend stock. Neither decision will change their life overnight. But 30 years from now, one of the greatest feelings in the world is waking up and realizing your younger self quietly built freedom while you were busy living life. That's what investing really is. Not excitement, not dopamine, not constant action. And the people who understand that early usually disappear from financial stress forever. Subscribe to Evans Invest if you want more videos about money psychology, investing, financial freedom, and the hidden systems quietly shaping your future. Because the most dangerous financial mistake is spending decades thinking you still have time.